Think of people who buy a house, give it a quick coat of paint, and try to sell it the very next month for a profit. In the stock market, that is called trading, the practice of chasing short-term margins through rapid buying and selling. Now think of someone who buys a house to live in, slowly paying off the mortgage and building equity over decades. That is investing. You are acquiring quality assets to hold for long-term growth. When you are just starting out, that patient, long-term approach is the safest path. It gives you the necessary time to learn how the market works, without the pressure of watching the clock. Look at these vintage stock certificates. In the past, if you wanted to invest, you actually held pieces of paper like these to prove you owned a piece of a company. Today, we have moved completely to electronic storage. Whether you want to eventually trade quickly or invest slowly, your very first step is exactly the same. You have to set up a specialized digital space to hold those ownership records. In India, that digital space is called a Demat account. Think of it as a secure digital vault required to hold your electronic shares safely. Setting it up is a simple logistical process. You select an online broker, provide standard identity verification documents like your PAN or Aadhaar card, and link the account directly to your regular bank account. Once that vault is open and linked, you have officially crossed the line. You are no longer watching the market from the sidelines. You are equipped to participate. The best way to learn is by doing, but with the volume turned all the way down. Transfer a very small test amount, say 500 rupees, into your new account. Use that money to buy exactly one share of a company you already know. Pick a brand whose products you see in your house or use every single day. Then do nothing but watch the daily price movements of that single share for an entire month. Do not worry about whether you are making a profit or taking a loss. This is a psychological exercise. You are letting yourself feel the natural, daily rhythm of the market's ups and downs without the heavy pressure of real financial risk. Before you add any more money, you need to understand how to protect it. Unpredictable market drops happen, and you need tools in place to keep your capital safe. This diagram shows a safety mechanism called a stop-loss order. As the asset drops, it hits a strict numerical threshold, instantly triggering an automated sale. By setting this floor, you place a hard cap on potential losses before they become devastating. The mechanics only work if you follow two core rules. Never put money into the market that you need for your daily living expenses, and actively practice suppressing emotional decisions driven by sudden fear or greed. Controlling your losses ensures you survive the market's natural volatility long enough for that long-term growth to actually happen. When people hear options trading, they picture a highly volatile, stressful environment. They imagine a chaotic rush, frantically chasing sudden, massive price spikes. But there is a quieter reality behind the noise. While buyers chase those sudden spikes, a different kind of movement is happening on the other side of the trade with the people selling these contracts. Think back to our real estate comparison. While speculators are sweating over quick property flips, the real wealth is steadily built by landlords calmly collecting rent every single month. Moving away from erratic, explosive price jumps and focusing on structuring predictable income is how you find a true advantage in the market. This document outlines writing a covered call. It generates income for people who already own shares, expecting the stock to move sideways. You sell a buyer the right to purchase your shares at a fixed price within a strict time limit. The moment you agree to this contract, you receive a non-refundable upfront cash fee called a premium. You keep this no matter what happens next. This logic model shows time decay. Like sand draining from an hourglass, the option contract's value inherently decreases as the deadline approaches. If the clock runs out, the contract expires. You keep your shares, the cash premium, and repeat the cycle. Treating your portfolio like a digital landlord, utilizing Demat vaults, enforcing stop-loss seatbelts, and applying calm strategies like covered calls transforms chaotic speculation into systematic wealth building.